This week, something happened that has never happened before in the history of financial markets. Gold futures on the COMEX breached $5,400 in a single session. Spot gold surged past $5,100. And the traditional rules that have governed how gold behaves, its relationship with Treasury yields, its correlation with the dollar, its response to interest rate expectations, all of them broke down simultaneously. At the same moment, silver, which had been left for dead after its historic 47% crash from $121 in late January, quietly staged a 32% recovery, and then this week it fell again, down 8% in a single day, down another 5% the next morning. And yet, Jane Street, the world's most profitable algorithmic trading firm, just purchased a record 20.6 million shares of the SLV Silver ETF, worth more than $1.3 billion, the single largest institutional silver position ever reported. Let that sit for a moment. The price is falling. The smartest algorithmic money on earth is buying. This is not a contradiction. This is the story. And if you understand why those two things are happening at the same time, you will understand exactly where gold and silver go from here. Let's start with gold, because what happened this week in the gold market is genuinely historic. A year ago, March 2025, gold traded at approximately $2,624 per ounce. In hindsight, that number looks almost quaint. Over the course of 2025, gold set dozens of new all-time highs, effectively averaging nearly one record per week. By January 2026, it had surged past $5,000 for the first time in history and hit an all-time high of $5,589. Then the Warsh shock hit, Trump's nomination of Kevin Warsh as Federal Reserve Chair. Gold cratered nearly 12% in 48 hours. The correction was brutal, and then, this week, something shifted again. On March 2, 2026, gold futures breached $5,400 in a single violent intraday session. The traditional correlation between gold and Treasury yields, which had held for decades, completely disintegrated. Normally, when real yields rise, gold falls. When the dollar strengthens, gold falls. Neither of those rules applied this week. What happened instead was a raw, unfiltered flight to safety, the kind that does not ask permission from monetary policy models. And the foundation beneath this move is not geopolitical noise. It is structural, institutional, and irreversible. In 2025 alone, central banks added over 800 tons of gold to their reserves. That is the third consecutive year above 1,000 tons of net official purchases when combined with prior accumulation. Poland, India, Turkey, leading a global charge to move away from dollar-denominated assets. The World Gold Council survey found that 43% of central banks globally plan to increase their gold holdings in the next 12 months, up from 29% just 1 year prior. These are not momentum traders. These are sovereign institutions with 10 and 20-year time horizons. They do not buy gold because the chart looks good. They buy gold because they are restructuring the foundation of global monetary reserves. And they are doing it because dollar-denominated assets can be sanctioned, seized, or devalued by political decisions they cannot control. As one professor of economics who advises central banks globally put it, dollar dependence is the underlying vulnerability. This is why central banks are paying a premium for gold. It creates a politically neutral, seizure-resistant reserve portfolio. JP Morgan's head of global commodities strategy put it plainly in their latest research. The long-term trend of official reserve and investor diversification into gold has further to run. JP Morgan's official forecast, gold averaging $5,055 per ounce in Q4 2026, climbing toward $5,400 by end of 2027. Goldman Sachs has a year-end target of $5,400 with what they call significant upside risk. Wells Fargo, $6,100 to $6,300. The floor under gold is not a sentiment floor. It is a sovereign demand floor, backed by the balance sheets of central banks that purchase regardless of short-term price movements. According to JP Morgan's own model, Every 100 tons of central bank and investor demand above the base threshold of 350 tons per quarter is worth approximately a 2% quarterly rise in the gold price. At 585 tons of projected quarterly demand for 2026, the math points in one direction. This week delivered two contradictory signals in the gold market, and both were real. On Tuesday, March 3rd, spot gold fell more than 5% to $5,041.81. Silver futures dropped more than 8% to $81.23. The catalyst? Fears that the U.S.-Iran war could last longer than markets originally priced in. Ironically, the safe haven asset was being sold into the very crisis it was designed to protect against. Why? Because when institutional investors face margin calls and equity losses, they sell their most liquid, profitable positions first. And for many funds in early 2026, gold was their most profitable position. The metal was not sold because it had lost its value. It was sold because it had gained so much value that it was the best thing to sell. This is the pattern that repeats in every major precious metals bull market. Temporary, violent, confidence-shaking corrections, followed by continuation of the underlying trend. It happened in 1979. It happened in 2008. It happened in 2011. And this week, even as spot gold fell, gold futures on COMEX simultaneously breached $5,400, reflecting the underlying institutional conviction about where the structural trend leads. The traditional correlation with Treasury yields has broken down. Gold reached its 10th consecutive quarterly record high in Q1 2026, something that has never happened before. Since reaching a low in early February, gold has been making higher lows and higher highs. The correction is real. The structure is intact. Those are two different statements, and both are true. Now, silver. And this is where this week's news gets extraordinary. Jane Street, the world's most profitable algorithmic trading firm, a company that processes more financial data before breakfast than most investors see in a lifetime, just made the largest single silver ETF purchase ever recorded. 20.6 million shares of SLV. More than $1.3 billion. They did not buy this at $121 when silver was making headlines. They bought it now, while the price is in the 80s, while retail investors are confused and scared, while the financial media is still writing about the crash. Separately, Swiss banking institutions executed one of the largest gold-to-silver reallocations in decades in the final quarter of 2025. Approximately $4.1 billion rotated out of gold and into physical silver. The last comparable shift of that magnitude dates back to the late 1970s. As Lars Hansen, head of research at the Gold and Silver Club, explained when asked about these moves, institutions of that caliber do not reposition billions based on momentum. They move when valuation extremes, regulatory incentives, and forward supply models converge. That convergence is now visible in silver. The gold-to-silver ratio currently sits above 59.1. This ratio has only exceeded 90.1 three times in the past century, in 1941, 1991, and 2020. Each time, what followed was a dramatic compression that generated extraordinary returns for silver holders relative to gold. Bank of America's head of metals research has issued his forecast, silver base case, 135 by end of 2026. Extreme case, 309 ounce. The methodology is not guesswork. It is historical ratio compression math. At the 2011 ratio low of 32.1 applied to current gold prices, $135. At the 1980 Hunt Brothers extreme of 1411, $309. Citibank, $150. First Majestic Silver CEO Keith Neumeyer, $130. And Gold Silver's Alan Hibbard was even more direct. I'm expecting silver to perform better in 2026 than it did in 2025. I wouldn't be surprised to see the price of silver increase by over $100 per ounce to $175 and above. Beyond the institutional moves, the price structure of silver is telling its own story. Silver's all-time high was $121.62 on January 29, 2026. It then crashed 47% to a low of $63.85 on February 6. Since that low, silver has staged a relentless 32% recovery, trading near $84. What is forming on the chart? A classic cup and handle pattern. The impulse wave up, the sharp pullback, the gradual recovery toward the neckline. Technical analysts identify 4 of 7 key indicators as currently bullish for silver. Silver mining stocks, tracked by the global X Silver Miners ETF, are trading above $107, still well above their pre-rally levels. Mining stocks tend to lead the underlying metal. They peaked 3 days before silver's spot price peaked in January, and they have been recovering faster. The market is in backwardation, meaning futures prices are below spot prices. This is rare and significant. It means buyers are willing to pay a premium for physical silver right now rather than wait for future delivery. The market is pricing urgency into the physical present, a signal that the supply chain is tight in ways the paper price alone does not capture. The most probable path for March, according to technical analysts, silver consolidates between $75 and $92. The breakout above $92 is the signal institutional money is waiting for before re-entering at scale. Hedge funds are, as of today, largely uninvested in silver, leaving enormous room for fresh institutional buying when the breakout comes. When the move happens, it will not be gradual. It will not give you time to react. That is how silver always moves. Amid all the price volatility, one set of numbers has not moved. Silver's global supply deficit is now in its 6th consecutive year. The Silver Institute forecasts a deficit of 67 million ounces in 2026. Global silver supply fell from 1.07 billion ounces in 2010 to approximately 1.03 billion ounces in 2024, while demand reached an estimated 1.2 billion ounces, creating a structural gap that grows wider every year. The world's largest primary silver producer, Fresnillo, just cut its 2026 output guidance from a previous range of 45 to 51 million ounces down to 42 to 46.5 million ounces. The world's #1 silver miner is producing less. At the exact moment demand is accelerating. Why can't supply respond? Because approximately 75% of silver is mined as a byproduct of copper, zinc, and lead. Production decisions are made based on those metals' economics. Higher silver prices do not automatically produce more silver. Even with silver at historic highs, it could be years before any meaningful supply response materializes. And demand is not waiting. Solar photovoltaic manufacturing consumed 29% of all silver industrial demand in 2024, compared to just 11% in 2014. Electric vehicles consume 67% to 79% more silver than traditional vehicles. AI data centers require silver-plated connectors that cannot be substituted. The Silver Institute reports solar applications alone now consuming over 140 million ounces annually, and that number is climbing every year as the green energy transition accelerates. The cumulative supply deficit since 2021 has now reached 820 million ounces, equal to an entire year of global mining output, drawn from above-ground reserves that took decades to build. The paper price can crash 47% in a week. The supply deficit cannot. This week, a single options trade on COMEX drew attention across every serious precious metals desk on Wall Street. A trader placed a $20,000 gold options trade, a bet structured to pay out $5.5 billion if gold reaches a specific target level. The cost of the position, $3.3 million. The potential payout, $5.5 billion. That is a 1,666 to 1 return structure. This is not a retail investor. This is not a momentum trade. This is a highly sophisticated, asymmetric bet made by someone with extraordinary conviction and extraordinary access to the kind of analysis that moves before the headlines. It is not evidence of insider trading. That would be an unfair characterization. It is evidence of conviction. Someone in the highest levels of financial markets believes gold has a clear path to a level that most investors today would call impossible. Placed quietly, no press release, no CNBC appearance, just capital moving with intent. Exactly the way the Swiss banks moved $4.1 billion into silver without a single headline. When institutions move in silence, that is when the rest of the world should be paying attention. Here is the full picture as it stands today. Gold is at $5,100, up more than 100% in 12 months, having set a new all-time high just 5 weeks ago. The world's central banks are accumulating it at twice their pre-2022 pace. 43% of central banks globally plan to buy more. Every major Wall Street institution has a bullish year-end forecast, ranging from $5,400 to $6,300. Silver is at $85, up 148% year-over-year despite the historic crash. It has a 6th consecutive supply deficit. The world's most profitable algorithmic trading firm just purchased $1.3 billion of it in a single move. Swiss banks rotated $4.1 billion into it quietly. The gold-to-silver ratio sits at a level that has historically preceded some of the most dramatic precious metals' outperformance in market history. And both metals are doing something their critics cannot explain away. They are rising even when they are supposed to fall, recovering faster than the panic that preceded each correction and attracting larger and more sophisticated institutional capital with each passing week. A senior research head at the Gold and Silver Club put the current situation this way. Silver markets are small relative to the scale of institutional capital. It does not take a tidal wave to create a squeeze, just sustained pressure. And he described March as a month where positioning can matter disproportionately. If physical demand accelerates into delivery windows, the repricing can be nonlinear. Nonlinear. That is the word that should stay with you. Not gradual, not predictable, nonlinear. When the world's largest banks are all pointing in the same direction, when the world's most sophisticated algorithmic traders are buying $1.3 billion quietly, when sovereign institutions are accumulating at twice their historical pace, when supply deficits have run for 6 straight years and cannot be fixed in months. The screen shows you today's price. The vault, and the institutions filling it, are telling you tomorrow's reality. Own the asset, not the panic, not the noise, not the paper promise. Own the reality. Stay informed. Stay positioned. Stay ahead.